The three-fund portfolio, also known as the lazy portfolio, will be discussed in today's video. This is a fairly common low-maintenance method of structuring an investment portfolio, whether it be for a retirement account, a taxable account, or just general investing. Before I start this video, I wanted to ask you, when was the last time you either built a framework or strategy for your investing portfolio or rebalanced it? Are you merely picking arbitrary stocks because you are familiar with the labels on your clothes? You own an iPhone, therefore you purchase Apple shares. You wear Nike running shoes, so you buy Nike stock. That's probably not the ideal long-term investment approach. In this video, we're actually going to talk about what the three-fund portfolio is, the advantages of having one, how to actually design one. Consequently, what is the three-fund portfolio? Therefore, to put it simply, it is a portfolio made up of three separate asset classes: U.S. stocks, U.S. bonds, and international stocks. So you're probably thinking to yourself, hey, so all I have to do is buy, say, Nike, a U.S. bond, and some international stock, right? You're not, sadly, because this invests precisely in three index funds, making them low-cost index funds. If you're unfamiliar with the term, an index fund is essentially a collection of equities that mimics or follows an index. For instance, we'll be monitoring U.S. stocks, U.S. bonds, and international stocks using these three index funds, which I'll describe in more detail later in the video. The benefit of this is that it offers excellent diversity while matching historically average market returns, and it also stops you from making irrational or emotional trading decisions when you see a hot tech stock that your neighbors are earning fortunes off of. This is a long-term strategy that is more balanced, but there's nothing wrong with making money from a hot tech stock. However, it is not the topic of this video. Having said that, let's discuss the advantages of this portfolio, now that you are aware of its components, before showing you how to create one. What are the three-fund portfolio's advantages? The first is what I just described, diversity. And there may be a fourth important one that I'll get to. You often hold 11,000 or more different equities in the typical three-fund portfolio, depending on what these index funds track or hold. The reason is because the two funds that I'll discuss with you after we actually construct one of these things generally hold 11,000 or more unique equities. Next up are the incredibly low fees. Vanguard index funds in particular, which have extremely low expense ratios, will be discussed since we are using them. Expense ratios are just a fancy way of saying fees, which means you would normally pay a financial advisor 1% of the assets they manage annually. With this, you'll presumably be at or more about 0.03% annually, which is a difference of 97 basis points. The third option is straightforward maintenance or balance. Now we've determined the various criteria for how much U.S. stocks, U.S. bonds, and foreign stocks we want to own. It's incredibly simple to do that because you can just rebalance that amount or wait to return to your allocation targets. And the last plus is that it's really simple to observe, comprehend, and sustain. Now that we have that out of the way, let's talk about how to develop one of these things, a three-fund portfolio. Let me know in the comments if you have any other questions about investing. Let's return to the video. Understanding your strategy, priorities, goals, and reasons for investing is the main caution when it comes to investing. Therefore, your age, the length of time you want to invest, and the level of risk you want to accept are often the three key criteria. Therefore, if you're 20 years old, have plenty of time, and have a high appetite for risk, you might add 100 stocks to your portfolio and completely forget about bonds. That negates the purpose of the return. However, I'm only using it as an example. If you're in your middle years, you should be a little bit more reasonable. It can make sense to be a little more cautious and hold more bonds if you're older and don't have a lot of time left on Earth. We have an 80-20 portfolio, which indicates that stocks make up 80% of the holdings and bonds 20%. Remember that we have U.S. foreign and U.S. bonds, as well as a 20-80 fund that consists of 20 stocks and 80 bonds. That is unquestionably the most balanced fund that we have. As a general rule of thumb, divide 110 by your age. For example, if you're 20 years old, 110 divided by 20 equals 90. Equities or stocks should make up 90% of your portfolio. What we basically have here is that I always told you that in this video, I'm going to tell you exactly what funds composed of these 3 fund portfolio, and it's the ones that are low-cost index funds. That is a fair metric or at least a solid beginning point. The mutual fund that I'm about to provide you is a Vanguard product. However, there are Fidelity equivalents as well as Schwab equivalents. Vanguard is being used as an example because they have extremely minimal funds and have historically performed quite well, but you can work this out on your own. Therefore, for the US stocks, we would either use VTI or VT-SAX, like saxophone. VT-SAX is the fund and VTI is the ETF. We would use VTL, an X, or VXUS for foreign equities, and VBTLX or BND, the ETF counterpart for US bonds. You want to make an 80-20 portfolio, which can be done with M1 Finance because it's so simple to set up and looks like a pie. Let's imagine that I'll merely slice off what amounts to 20. That would be US bonds. This would be a bond, and after that, you may split your investments between US equities and foreign stocks. For instance, if I wanted to use the 80-20-64 of this portfolio, I could just assume that this slice was 64. I would really go to the American stocks, so let's use VTI as an example. Finally, this third portion would be the foreign stocks, and you could utilize VXUS for that. I enjoy M1 Finance since the whole idea of the product is a pie. You may easily enter 64 VTI, whatever the 16 VXUS, and then 20 bond into your weights, and voila! You have an 80-20 portfolio. Less is more, and because it's not daunting and has all the advantages I outlined in the video, this is a wonderful place for novices to start. It requires little upkeep, is simple to rebalance, and saves you from having to check a gazillion different stocks. But I'm only making the point that you don't have to actively trade if you use these 3 funds. You could essentially set it and forget it, and rebalance it maybe once every 6 months. Second, historically low bond yields are a factor. The traditional 60-40 portfolio, 60 stocks, 40 bonds, known as the risk parity portfolio, has performed well since essentially the 1970s or 1980s up until now. But the returns or having a portion of your portfolio in bonds may not provide the yields like it used to. So that's something to be aware of. Bond yields are currently extremely low. Be mindful that bond yields are low and that this is a wonderful place to start for anyone looking to get started. Since building a portfolio can be frightening, this is one of the simplest ways to do so without putting your entire account at risk. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.